Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. So in today's session, we are going to discuss two very important news articles. The first one is regarding the Supervisory Data Quality Index that has been released by the Reserve Bank of India, and like the other index of the Reserve Bank of India, the Data Quality Index also has different parameters, as well as the Reserve Bank of India released a booklet with this Supervisory Data Quality Index. So we will discuss that what are the important points that have been given in the booklet also. Okay, so we will discuss about the Supervisory Data Quality Index, the data that has been provided for this, as well as what are the important data points that we will discuss. Okay, next is NPCI and IDRBT has signed the MOU in regards to cyber resilience and the payment security. So we will discuss that why, what is the aim of this MOU and what different things will be done under this MOU, so that we are going to discuss in today's session. So both these news articles are very important and we will discuss them in length. So let's start with this, but before that, give me a thumbs up if everything is clear, if I am clearly audible and visible. So let's start with the session, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session. Okay, so starting with the Supervisory Data Quality Index for the scheduled commercial banks. So Reserve Bank of India has created a Supervisory Data Quality Index that measures the data quality in terms of the accuracy, timeliness, completeness and consistency in the submission of returns. So first of all, try to understand that the high quality data, it is a precondition for the risk assessment, for the risk analysis. The Reserve Bank of India takes the reports or take the returns from the different supervised entities, from the banks, from the NBFCs. The Reserve Bank of India take the data points so that the high quality data can provide the understanding to the Reserve Bank of India in regards to risk assessment, that where the risk is arising, in which domain, in which segment the risk is arising, and the RBI can take the preemptive steps and the proactive steps can be taken by the Reserve Bank of India. Okay, so remember that the high quality data, it is always a precondition for the risk analysis. If you do not have the data, how you are going to do the risk analysis, that where the risk is arising, the banks. So previously the banks were giving too much loans to the personal loan category, or the banks were giving too much loan to the NBFCs. So RBI said that there is concentration risk that is arising because there is a lot of loan that is going in a particular category. So you can understand that the Reserve Bank of India uses the high quality data for the risk analysis and for handling the risk in the country. Okay, now the RBI, where do the RBI get the data? The RBI get the data from the supervised entities only. The RBI is getting the data. It's not like that RBI is going and seeing the working of each and every bank, each and every NBFC. No, the RBI collects the data from all these banks. RBI collects the data from all these NBFCs. Okay, so all these NBFCs and the banks, they have to provide the supervisory returns, or they have to provide the reports to the Reserve Bank of India having the high quality data. Okay, so this is the basic idea. So the Reserve Bank of India has created a Supervisory Data Quality Index that measures the data quality in terms of accuracy, timeliness, completeness and consistency in the submission of returns that is submitted by the supervised entities, that is the banks, NBFCs and such. Okay, so here you can see that a master direction was released in February 2024. This was the master direction. These were the directions or the provisions that the RBI has laid down, in regards to supervisory returns. Okay, so all the supervised entities, they are required to submit certain supervisory returns to the Reserve Bank of India as per directions or circulars or notifications issued by the Reserve Bank of India. All the supervised entities, let it be the commercial banks, all the primary urban cooperative banks, all India financial institutions and all non-banking financial companies excluding housing finance companies and all the asset reconstruction companies, all of these are the supervised entities that have to provide the data, that have to submit certain supervisory returns, that have to provide data to the Reserve Bank of India. They have to submit the supervisory returns for the Reserve Bank of India. Now what happened, that a master direction was released. So previously there were different guidelines for the different entities, but later on in February 2024, RBI released the master direction. So this became a single reference for all the supervisory returns and harmonized the timelines for filling the returns, for submitting the returns to the Reserve Bank of India. Okay, and under this master direction, there were various provisions that were provided by the Reserve Bank of India. Now, I have brought some provisions for you so that you are able to understand that this master direction had certain principles. On the basis of the principles, the Supervisory Data Quality Index check the quality of data. Okay, so this master direction, this is the single reference point. This is the single reference point for all the supervised entities in regards to the guidelines, in regards to the provisions or the rules that the supervised entities have to follow when they are submitting the returns, when they are submitting the reports to the Reserve Bank of India. So this master direction is the single reference point for all the supervised entities when they are submitting their returns to the Reserve Bank of India, or when they are submitting their data to the Reserve Bank of India. Now, the Supervisory Data Quality Index, it checks or it measures the quality of data, and the objective of Supervisory Data Quality Index is to assess the adherence to the principles of this master direction. So there are the provisions, certain provisions that you can see of this master direction, that the master direction states all the returns, all the reports that the supervised entities are providing, they should be rechecked. All the returns, all the reports that are generated through the automated tools, that are generated through the third party systems, all returns, all reports generated through any of the means by the supervised entities, they should be rechecked with the supervised entities' own sources, including the accounting data that the supervised entities have. So that means there should be cross verification of the data that should happen before submitting the returns to the Reserve Bank of India, so that the data is accurate and the data is complete. No data is being left behind. That is important. So important data should not be left behind. So the data should be complete and accurate. There should be cross verification, that is compulsory. Okay. Next is build the supervised entities. They have to build and maintain the data architecture and supporting in IT infrastructure for accurate, complete and timely data aggregation. See, the banks have different branches. It's not like that the bank has all the data. The bank branches are there. There are hundreds of bank branches spread around the country. So you can understand that the data has to be collected from different branches. The data has to be collected from different systems. The data has to be collected from different departments. So it is said that the supervised entity should build and maintain the data architecture and supporting IT infrastructure for accurate, complete and timely data aggregation from the different departments, from the different branches and different systems, so that the data is getting aggregated, the data is getting at one place, it is getting compiled from the different domains also. Okay, and reporting not only in normal times. It's not like that only in the normal times the reporting of the data should happen. Even during the stress situation, the bank should be able to report the data. The NBFCs and the supervised entities should be able to report the data. So reporting of the data should not only be in the normal times, but also during the times of stress or crisis. Even in that times, the data has to be submitted. Last is that risk data aggregation capabilities. Now, this is important to understand because it is linked to the international guidelines also, the standard guidelines and the standard setting. So that's why I'm explaining it here. Okay, so risk aggregation, risk data aggregation. So see, the bank, if they have high or if they have better data collection, or they have the data collection capability. So if a bank or if the NBFCs, they have the high or better data collection capability, so that shows that they are able to collect the data from the different departments, from the different systems, from the different branches for the different domains, for the loans, because NBFCs and the banks, they are giving the loans as well as they are doing the investment, as well as the banks, they are also engaged in the foreign exchange operations. Okay, so you can understand that if the banks have better or they have high data aggregation ability, they will be able to collect the data from the departments, from the systems, from the different branches that they have for the different domains, and the risk that is arising from the different loan categories. As you know that the risk weight is given for the different personal loans, for the home loans, for the car loans, for the loans that is given to the state governments and such. So the loans that are given, they have the different risk weight, they have the different risk category. So the bank will be able to collect the data for the risk that is arising from the loan segment, the risk that is arising from the investment that has happened in the shares of different companies, the investment that the bank is doing in the securities, in the debt instruments of the different entities, and the other securities like the derivatives and such. The risk that is arising from the forex operation. So basically, the risk data aggregation capabilities. So the bank has to, or the NBFC has to fully document that what is the risk data aggregation capability of the bank or the NBFC. If the bank or the NBFC have high risk data aggregation capability, that means they are able to aggregate, they are able to collect the data in regards to the risk that is arising from different domains, and they are also able to report such data to the Reserve Bank of India, so that the Reserve Bank of India know that okay, there is a lot of risk that is arising from the investment in the derivatives. There is a lot of risk that is arising from the loans that is given to the personal loan category. So RBI will take prudent measures to handle these kind of situation and handle these kind of loans, okay, or the investment that the bank is doing, and the RBI can release the guidelines for the banks to follow or NBFCs to follow, so that they are having prudent measures and they have the enough of the capital base, okay. So this is the idea that risk data aggregation capabilities and risk reporting practices should be fully documented, so that the RBI can understand and the RBI can know that which bank has the capability to provide the risk data and to provide the collective risk data, and which bank do not have the risk data aggregation capability. So those banks will have to work harder to increase their risk data aggregation capability and to provide the risk data to the Reserve Bank of India, okay. And it's not like that the bank will say we have high risk data aggregation capability, we can collect the risk data very easily. You have to validate it also, okay. So there should be standards of validation also. If a bank is saying that they have high risk data aggregation capability, so that should be validated also, checked also, okay. So this is the idea. So here you can see that these are the provisions that have been laid down. So these are the provisions that have been laid down in the master direction. So these are the provisions that have been laid down in the master direction, and they show the principles in the master direction, that is the principle of accuracy and completeness, the principle of accurate, complete and timeliness, as well as the standards of validation. That means the consistency has to be maintained, the validation, the accuracy has to be maintained and such. So there are certain principles that are laid down. So through the provisions or through the guidelines that are laid down in the master direction, there are certain principles that the master direction is showing. The principles of accuracy, the principle of completeness, the principle of timeliness, and the principle of consistency. And these principles or these dimensions are checked through the supervisory data quality index, that the banks, NBFCs, the supervised entities, are they able to meet these principles? Are they able to meet these dimensions or not? Okay. So this is the basic idea. So this supervisory data quality index score, the scheduled commercial banks has improved. So the supervisory data quality index score for the scheduled commercial bank has improved in March 2025 as compared to March 2024. That means the data accuracy, the data timeliness, the data completeness and the consistency has improved for the scheduled commercial banks. Till now, any confusion anyone has? I wanted you to understand the principles so that you are able to understand the whole notification. Now everything will be very easy for you, because you have understood that in the master action the objective is very important. The objective of supervisory data quality index is to assess the adherence to the principles expressed in the master direction through the provisions of the master direction, okay. So now coming to the data points. So the supervisory data quality index, so it sees the data quality through these four dimensions, okay. This supervisory data quality index for the scheduled commercial bank was 88.6 for March 2024. That has increased to 89.3 for March 2025, okay. So majorly you have to remember the complete data points, the supervisory data quality index scores, rather than remembering all the subcategories or all the dimensions data. That is not possible to remember. So just remember the main supervisory data quality index score, okay. And if this score is 89.3, what does this score states? This score states, so basically if the score is less than 70, that means there are major concerns in the data quality. The data quality is not good. The risk assessment cannot happen through that data, or the risk data assessment is not, like the risk data aggregation is not good and such. 70 to 80 needs improvement. Okay, the quality of data is fine, but it needs a lot of improvement. The 80 to 90 means acceptable, that the data quality is acceptable, it is good. More than 90 means it is very good, or it is good in it is better than the acceptable category, basically. So the scheduled commercial banks are in the acceptable category, that their data quality is acceptable. It is not good, it is acceptable. Okay. Now for the small finance banks, they have the data quality that is in the highest range, that is the good data quality they have. The small finance bank, they have the data quality more than 90. So this is the basic idea, that the supervisory data quality index has been laid down for the different bank segment, for the public sector bank, private sector bank, foreign banks, small finance banks, and for the small scheduled commercial bank in total. So for them, the supervisory data quality index score has been given, and for the scheduled commercial banks, you can see that the data quality index score has improved from 88.6 to 89.3, but they are still in the acceptable limits, not in the good limit, we can say. For the small finance banks, they are in the good category. Okay, they are in the good category. Now this is the idea. So timeliness for the scheduled commercial banks, their timeliness has improved. That means they are doing the timely submission, that has improved. The completeness has slightly decreased. The accuracy has improved, and the consistency has also improved, as well as the complete score for the scheduled commercial bank has improved to 89.3. That is what you have to remember. Now what is the meaning of consistency, accuracy, timeliness, and the completeness? By the term itself, you might be able to understand a brief idea of the timeliness. That means everything, every returns, every reports have to be submitted in the timely manner. So that is correct. Okay, so timeliness checks number of instances of delays in a year. So how many times the delay has happened in the submission of the returns, in the submission of the reports. Okay, number of days or days delay in each submission. So in each submission, let's say the delay for 4 times the delay has happened in the submission returns, and the delay is by 10 days, by 5 days, or only by 2 days or 1 day. Okay, so the days of delays is also seen, because that is also serious. If the delay is happening by a lot of days, that is more serious. Okay, number of revisions that has happened before submitting the data. Okay, completeness. So completeness shows the submission of all returns, that all the returns that the RBI has asked, have they been submitted. Next is mandatory fields. All the mandatory fields, have they been filled by the banks or NBFCs or the other supervised entities. Accuracy within current time period, the accuracy of the data, as well as with past periods data. In comparison to past periods data and with the past period data, the accuracy is checked. Okay, within returns, within each submission return, what is the accuracy, as well as between returns validation. So validation also happens, that is shown that whenever the bank is giving the data, it has to be cross checked. So between returns validations, it is checked that how much accuracy is there. Other data sources, through other data sources also accuracy is checked. Okay, consistency. Now average of accuracy scores of past periods. So consistency is checked in the quarterly data, that the quarterly data, do they have consistent data quality and do they have the consistency. Okay, so if you want to know more about the accuracy, completeness, timeliness, and consistency, so here you can read. So consistency, the dimension of consistency checks for the consistent accuracy of data for the previous quarters, that the data has been consistently accurate in the previous quarters or not. Okay, in the year. Timeliness, so timeliness assessment is based on timeline prescribed in the master action. So in the master action, as I've shown you, that there are provisions. There are the provisions under this master action, that the returns have to be submitted in the timely manner, and the timeline has also been given, that when the returns have to be submitted. Okay, so the timeliness shows that the timeline prescribed in the master action, is that being followed or not. Okay, completeness, the dimension of completeness assigns scores based on the data submitted in each return and the number of returns that is submitted and the mandatory fields that are filled. The accuracy, it shows the data submitted in each return, is it accurate, that is in the quantifiable concerns within and across return validation. Unexplained deviation that is coming from the past, unexplained. See, if the deviation is coming, let's say the data was 10, now the data is 100. Now it is explained that the deviation has come because of the COVID. Because of the COVID, the deviation has come and the people required more loans to sustain. Okay, so that deviation can be explained. Now there is certain unexplained deviation. Unexplained deviation means that there is no particular reason for the deviation, so that unexplained deviation is more harmful, because the banks are not able to understand that why the problem is coming or why this deviation is coming. So it is the unexplained deviation from past levels and trends. So that is also checked, that how much unexplained deviation is there. If the unexplained deviation is less, so that is fine, but if it is more, that is problematic. Okay, so these are the different dimensions that I have shown you. There are 4 dimensions, and under these 4 dimensions there are certain indicators through which the supervisory data quality index is prepared. Okay, and the supervisory data quality index has improved from March 2024 to March 2025. I hope this is clear. Now coming to distribution of supervisory data quality index scores for scheduled commercial banks. So in total 87 scheduled commercial banks were checked for the supervisory data quality index, and it was seen that in one scheduled commercial bank, the supervisory data quality index was in between 70 and 80. That means it was not good. Okay, now for 44 between 80 and 90, that means this was 44 were in the acceptable range, and more than 90, so 42 scheduled commercial banks were able to get the score more than 90, so they were in the good category. So this is the idea, that out of 87 scheduled commercial banks, one scheduled commercial bank was in the range of 70 to 80. That is need improvement. This category is need improvement. Okay, between 80 and 90, 44 scheduled commercial banks were in between 80 and 90. That is acceptable, and 42 scheduled commercial banks were in the category of more than 90. That is good. Okay, now the scheduled commercial bank, the supervisory data quality index for scheduled commercial bank covers 87 scheduled commercial bank and their key returns. That is the return on asset liability and off balance sheet exposure, the return on asset quality. So there are different returns that are seen. The data is seen for different returns. Okay, so this is the basic idea. Any confusion till now? So some additional information, as I've told you that with the supervisory data quality index, there was also a methodology paper that was released. So we have discussed the methodology, that there are 4 dimensions. Under the 4 dimensions there are different indicators, but there were some additional points that were also mentioned that seemed important. Okay, so master direction of the Reserve Bank of India, filling of supervisory returns directions, issued on February 2024, is motivated by Principle 13 of the Basel Committee on Banking Supervision. So I hope you know that Basel Committee, it is the international standard setting body. Okay, so Basel Committee on Banking Supervision is the primary global standard setter for the prudent regulation of the banks, and provides a forum for regular cooperation on the banking supervisory matters. Okay, so this is the basic idea. This is the Basel Committee, that is the international or the global standard setting body that sets the global standards. Okay, now the master direction that was released in February 2024, it is motivated by Principle 13 of Basel Committee on Banking Supervision, which states that supervisors, that is the RBI is the supervisor that supervises the supervised entity. So RBI is the supervisor. Supervisors should have and use the appropriate tools and resources to require effective and timely remedial action. So the supervisors have to take the remedial action, or they have to make the banks or the NBFCs take the remedial action to address deficiencies in the risk data aggregation capabilities and risk reporting practices. So basically the idea is that as per Principle 13 of Basel Committee, the supervisors, they have to make sure that the banks or NBFCs that have the deficiency, that have the problem in risk data, that have the deficiency in risk data aggregation capability. That means the banks or NBFCs, they do not have good ability to do the aggregation of risk data, to aggregate the risk data. So the banks and NBFCs that do not have the capability to aggregate the risk data, those banks and NBFCs, the RBI has to take steps for those banks and NBFCs, so that the banks and NBFCs, they can improve their risk data aggregation capabilities, because the risk data has to be collected from different departments, branches and systems for the different domains, for the loans, what is the risk for the different categories of loans, what is the risk for the investment, what is the risk that is arising. Okay, so supervisors, that is the RBI, should have and use appropriate tools and resources to require effective and timely remedial action by a bank to address the deficiency in its risk data aggregation capability and risk reporting practices. Because if the bank is not able to collect the risk data and the bank is not reporting the risk data correctly, that means RBI will never be able to know that where the risk is arising. If the bank is not reporting the risk data correctly, okay, if the RBI is not able to know that where the risk is arising, RBI will not be able to take the prudent step. If RBI is not able to take the prudent step, the bank, when something blows up, the bank will be failing. Like it happened with the case of Yes Bank, that the Yes Bank, the data was not very sufficient, the CRAR was very low, the bank was not showing its data correctly, and at last the bank was on the verge of closing down. The RBI had to help it out. In the case of IndusInd Bank also, we have seen that if the reporting does not happen properly, the IndusInd Bank went into a huge problem, and there was a lot of news that was going on that it might close down. RBI had to come up to say that, okay, no, IndusInd Bank is safe, it has good CRAR, it has good financial data, or the financial system of the bank is prudent, or it is fine. Okay, but IndusInd Bank did create a problem by showing that it has a lot of data discrepancy, or the accounting discrepancies there. Okay, so this is the idea. Now many central banks such as the European Central Bank and Federal Reserve Bank of Kansas City prepare such data quality indexes. So it is not only India that is preparing the supervisory data quality index, it is not only RBI that do so, it is done by European Central Bank as well as Federal Reserve Bank of Kansas City. Even the International Monetary Fund also creates such data quality index to check the data quality of the data that IMF is getting from the member countries. Okay, so this is the basic idea. Now coming to the second news article, that is regarding NPCI and the IDRBT that has signed MOU. So NPCI, that is National Payments Corporation of India, and the Institute for Development and Research in Banking Technology, they have signed a memorandum of understanding to collaborate on the initiatives that aim to strengthen the cyber security and resilience in the India's digital payment ecosystem. Under this MOU, they will jointly conduct the targeted training programs for tech and cyber professionals in the banking and digital payment services sector, as well as they will also like NPCI, there will be exclusive NPCI certified payment security certification program that will be run. So in the partnership, that is the two institutions, they will also lead to the development of a exclusive NPCI certified payment security certification program. Okay, aligned with emerging industry needs and regulatory expectations. Now in addition, IDRBT will also extend the Sachet IBCART. IBCART is the Indian Bank Center for Analysis of Risk and Threat. So we have the Indian Bank Center for Analysis of Risk and Threat. So in addition, the IDRBT has said that they will also extend the Sachet, that is IBCART 3.0, the threat intelligence services to NPCI. So IDRBT will be sharing its threat intelligence services to NPCI and its ecosystem partners. So that is a good deal, because the information that the IDRBT has, the information that the Indian Bank Center for Analysis of Risk and Threat is getting under the IDRBT will be shared with the NPCI also. So this is a good deal. So these are the three steps that you have to remember. Now coming to the last additional point. So IDRBT, it is the Institute for Development and Research in Banking Technology. It was established as an independent autonomous organization established by RBI in 1996. It focuses on research, development, training, consultancy in the banking technology, and it also serves as a certifying authority for digital certificates within the banking and financial sector. And you all know about the NPCI. It is the central body responsible for overseeing the retail payments and settlement systems in India. It is established by the Reserve Bank of India and the Indian Banks Association. So NPCI, it brings innovation in the retail payment system, the UPI, the Bharat Bill payment system. They all were the ideas or the creation of the NPCI in collaboration with the different entities. Okay, so you can understand that the NPCI is focused on bringing innovation in the retail payment system by using technology for achieving greater efficiency in operations. Okay, so IDRBT and NPCI, they have signed a MOU so that they can jointly work on cybersecurity and resiliency in the India's digital payment system. So they are providing targeted training program for the professionals, as well as they are jointly conducting or they are jointly developing exclusive NPCI certified payment security certification program, as well as the IDRBT will be extending the IB CART 3.0, the threat intelligence services, to NPCI and its ecosystem partners. Okay, so this is the idea. Any confusion anyone has? So this is the first question. I hope you will be easily able to answer this question. So the Reserve Bank of India has developed the index. You have to tell that which of the following are the dimensions of this index. Next question is in regards to improvement that has happened in the scheduled commercial banks supervisory data quality index. So what is the improvement that you have to show, or the new data that you have to show? So NPCI has signed the MOU with whom, with which institution, so that you have to show. Okay, now before ending the session, so there is perspective 360-degree session, that if you want to do the answer writing practice, if you are afraid that how I will be able to write the answers, or what are the steps to write the answer, what are the current topics that are the hot topics on which a question can come in the examination for the answer writing. So in the perspective 360-degree, you are getting the questions for practice, you are getting the art of writing the answer, or Jaskran sir will help you to write the answers, as well as he is taking the current topics that are very important from the exam perspective, that can, from where the descriptive questions can come. Okay, so this is perspective 360-degree sessions, that is for your answer writing practice. If you write the answers in the comment section of this series, you also get these answers evaluated. Okay, so the team evaluates your answers. So this is the series that happens at 5 p.m. Monday, Wednesday and Friday. And now if you have any confusion in today's session, do ask me. Any confusion anyone? Okay, so the Indian Bank Association, it was established in 1946 as an interface between the RBI, government and the banks. So it is not specifically said that IBA is a SRO, because the SRO is a new concept, while the IBA was established way back and it is already working as a very important, it is already having a very important role in between RBI, government and banks. It connects the banks, it provides the interface that connects the banks with the government and the RBI. Okay. Any other confusion anyone has? No other confusion? All clear? Okay. Okay, then thank you everyone. Thank you for joining the session. See you in the next session. Okay. Thank you everyone. Thank you for joining. And okay, the PDF is usually provided within 24 hours, but as the team, like, it is holiday, so today we don't have the working and the team is not working, so the support team will not be sharing the PDF today. They will be sharing it by Monday. Okay, so usually you will get the PDF within 24 hours of the session being conducted, but as the first and the third Saturdays are off in our organization, so you will get the PDF on Monday rather than tomorrow.